What I am about to tell you is going to sound insane. It is going to sound like the ramblings of a madman. It is going to sound so outrageous that your first instinct will be to click away and find something more reasonable to watch. But I need you to stay. I need you to listen. Because what I am about to reveal is not my opinion. It is not wishful thinking. It is the projection of one of the most respected voices in the precious metals community. A man who has been right about this market for decades. A man who just stood on stage at the Vancouver Resource Investment Conference and said something that made the entire room go silent. Willem Middelkoop looked at the audience and asked a simple question. Is silver finally threatening JP Morgan? And then he answered it. He said a short squeeze could push silver to $400 to $500 by the second quarter. Let that number penetrate your brain, $400 to $500 per ounce by Q2. That is not a decade from now. That is not a 5-year projection. That is months away, weeks away. The next earnings cycle, the next FOMC meeting, the next geopolitical crisis. And this is not some random person on the internet making wild predictions. This is Willem Middelkoop, a man who founded the Commodity Discovery Fund, a man who has been studying precious metals manipulation for longer than most of us have been investing, a man who understands the mechanics of the futures market and the derivatives exposure and the short positions better than almost anyone on the planet. He is saying $400 to $500 by Q2. And I am going to show you exactly why he might be right. And today we are going to dissect the most explosive prediction in the history of the silver market. We are going to look at why JP Morgan is finally trapped. We are going to look at why the short squeeze is not just possible but probable. We are going to look at the gold to silver ratio and what it tells us about where this price is heading. And we are going to look at the timeline, because the timeline is everything. And the timeline is now. Silver just broke $103 for the first time in history. $103. A price that seemed impossible 6 months ago. A price that the skeptics said we would never see. A price that the banks and the manipulators and the paper pushers fought against with everything they had. And they lost. They lost at $50. They lost at $75. They lost at $100. And now they are about to lose at levels that will bankrupt them. But before we talk about $400 and $500, we need to understand what is happening right now. We need to understand why the short positions have collapsed. We need to understand why the smart money is running for the exits. We need to understand why Willem Middelkoop chose this moment to make this prediction. Silver short positions have reached their lowest level since November 2023, the lowest in over a year. The shorts are covering. The shorts are fleeing. The shorts are doing exactly what you would expect them to do when they realize they are on the wrong side of a trade that is about to go parabolic. Think about what that means. For years, decades even, the short sellers have had their way with the silver market. They have naked shorted it into oblivion. They have dumped paper contracts by the billions to suppress the price. They have coordinated attacks during low-volume trading sessions. They have done everything in their power to keep silver from reaching its true value. And now they are running. Now their short positions are at multi-year lows. Now the ammunition is depleted and the reinforcements are not coming. They see the writing on the wall. They see the physical demand overwhelming the paper supply. They see the Shanghai premiums and the empty vaults and the sold-out mints. And they are getting out before the tsunami hits. But here's the thing about short squeezes. They do not happen gradually. They do not unfold in an orderly fashion. They explode. They trigger cascading margin calls. They force covering at any price. They create feedback loops where every uptick in price forces more shorts to cover, which pushes the price higher, which forces more shorts to cover. This is the mechanics of destruction. This is how markets break. This is how prices that seemed impossible on Monday become reality by Friday. And when you have a market as manipulated as silver, when you have decades of accumulated short positions built up by the biggest banks in the world, when you have a physical shortage colliding with a paper pyramid, the squeeze is not just violent, it is apocalyptic. Willem Middelkoop is not just predicting a rally, he is predicting a market event, a structural break, a moment where the fraud is exposed and the price discovery mechanism finally starts functioning after decades of suppression. $400 to $500 is not a target, it is an inevitability. It is what happens when decades of manipulation unwind in months. But Middelkoop is not the only voice sounding the alarm. There is another analyst whose work you need to understand, another projection that provides the mathematical framework for what is coming. His name is Rashad Hajiev, and he just revealed something about the gold to silver ratio that should make every precious metals investor sit up and pay attention. The gold to silver ratio is one of the oldest metrics in finance. It measures how many ounces of silver it takes to buy 1 ounce of gold. Simple division, gold price divided by silver price. But that simple number tells you everything about where we are in this cycle. And right now, it is telling us that silver is about to enter its most aggressive phase. Historically, during strong silver bull markets, the ratio falls sharply. When silver starts outperforming gold, when silver starts leading instead of lagging, the ratio compresses. In previous cycles, major silver peaks have coincided with the ratio falling into the 30s, or even low 30s. In 1980, when silver hit $50, the ratio dropped below 20. In 2011, when silver touched $49, the ratio fell into the low 30s. Now look at where we have been for the last few years. The ratio stayed elevated, often above 80, sometimes above 90. That told a clear story. Silver was underperforming gold badly. Silver was being left behind. Silver was being suppressed while gold was allowed to rise. But that dynamic is changing. Fast. Silver just broke into triple digits. Silver is starting to lead. The ratio is compressing. And Rashad Hajiev has identified a descending channel on the ratio chart that has been in place for decades. A channel whose lower band targets a ratio near 18. 18. Let that number sink in. A gold to silver ratio of 18. That is not a wild fantasy. That is the mathematical target based on decades of price history. That is where the ratio has gone during previous silver manias. And if it goes there again, if history repeats as it so often does in these markets, the implications for silver are staggering. Rashad tied the ratio target to a gold price scenario. If gold reaches $6,000 per ounce and the ratio compresses toward 18, silver would mathematically trade above $200 per ounce, above 200. That is not opinion. That is arithmetic. 6,000 divided by 18 equals 333. But even at a more conservative compression toward the low 20s, you get silver above 250, above 280, numbers that make the current $100 price look like a discount. And here's the key insight that most people are missing. This projection assumes gold only reaches 6,000. What if gold goes to 8,000? What if gold goes to 10,000? What if the dollar collapse accelerates and gold enters a true hyperinflationary melt-up? Every dollar higher that gold goes, with the ratio compressing, silver goes higher by multiples. The gold to silver ratio is not just a metric, it is a leverage multiplier. It tells you that silver's upside is a function of gold's upside times the ratio compression. And when both of those factors are moving in silver's favor simultaneously, the gains are exponential. Gold at 6,000 with an 18 ratio equals silver at $333. Gold at 8,000 with an 18 ratio equals silver at $444. Gold at 10,000 with an 18 ratio equals silver at $555. Do you see the math? Do you see why Middle Coop's $400 to $500 projection is not crazy? It is actually conservative if gold continues its trajectory and the ratio does what it has always done during silver bull markets. Now I know what some of you are thinking. You're thinking these numbers are too extreme. You're thinking the market would never let silver go that high. You are thinking the manipulation would kick in and stop the rally before it reached those levels. And I understand that skepticism. I really do. Because we have been conditioned to expect manipulation. We have been trained to expect the banks to smash the price every time it gets too high. We have watched them do it over and over and over again. At $18, at $26, at $30, at $50. Every time silver threatened to break free, the hammer came down. But something is different this time. Something fundamental has changed. The physical market is breaking away from the paper market. The Shanghai price is diverging from the New York price. The premiums are exploding. The vaults are emptying. The mints are selling out. The industrial users are scrambling. The central banks are accumulating. You cannot suppress a price with paper contracts when the physical metal does not exist. You cannot naked short something into oblivion when the buyers are demanding delivery. You cannot maintain the illusion of abundant supply when the refineries have nothing to refine and the workshops have nothing to craft. The manipulation worked when the market was paper versus paper, when the shorts could print contracts faster than the longs could buy them, when the game was played entirely in the abstract realm of futures and derivatives. But that era is ending. That paradigm is shifting. The market is demanding physical settlement, and physical metal cannot be created with a keystroke. JP Morgan knows this. They have known it for years. Why do you think they accumulated the largest hoard of physical silver in history while simultaneously maintaining massive short positions in the paper market? Because they were playing both sides. Because they were suppressing the price with paper while accumulating the physical at artificially low levels. Because they were preparing for exactly this moment. But even JP Morgan cannot fight the tide forever. Even the largest bank in America cannot stand against the combined buying power of China and India and Turkey and the Middle East. Even their legendary trading desk cannot defeat the laws of supply and demand when the supply is finite and the demand is infinite. The short positions at their lowest level since November 2023 tells you everything. They are covering. They are reducing exposure. They are preparing for a move that they cannot stop. The smart money inside the banks sees what is coming, and they are positioning accordingly. Willem Middelkoop asked the right question. Is silver finally threatening JP Morgan? And the answer is yes. For the first time in decades, silver is not just threatening JP Morgan. Silver is poised to destroy them, to expose the manipulation, to reveal the fraud, to trigger the short squeeze that will rewrite the history of the precious metals market. $400 to $500 by Q2. That is not a hope. That is a timeline. That is a projection based on the mechanics of the market and the math of the short positions. When the squeeze triggers, when the cascade begins, when the margin calls start hitting, the price will not rise in an orderly fashion. It will gap. It will jump. It will teleport from level to level as the sellers disappear and the buyers panic to acquire whatever metal remains. You will wake up one morning, you will check your phone, and you will see that silver did not trade at 120 or 130 or 150. You will see that it opened at 200 or 250 or 300. Because when a short squeeze triggers in a market with no supply, there is no resistance. There are no sellers. There's only the desperation of the shorts trying to cover and the stubbornness of the longs refusing to sell. This is what happened in palladium a few years ago. The price went from 500 to 2,000 in a matter of months. This is what happened in rhodium. The price went from 1,000 to 29,000. These are not theoretical scenarios. These are real-world examples of what happens when industrial metals with constrained supply enter squeeze conditions. Silver has more industrial applications than palladium. Silver has tighter supply constraints than rhodium. Silver has more accumulated short positions than almost any commodity on Earth. The setup is not just favorable. The setup is explosive. The fuse is lit. The question is not if. The question is when. And Middelkoop says, when is Q2, the second quarter? April, May, June, the months immediately ahead. The window of time we are entering right now. There is another factor that most analysts are overlooking. Another development that could accelerate the timeline and amplify the magnitude of the squeeze. The Dutch government has proposed a tax on unrealized investments, a tax on gains you have not even realized yet, a tax on the paper value of your portfolio. This might seem like a small policy change in a small European country, but the implications are massive. If this becomes law, if other countries follow suit, if the concept of taxing unrealized gains spreads across the Western world, what happens to investment behavior? Where does capital flow when governments start taxing you on gains you have not even taken? It flows to hard assets. It flows to physical commodities. It flows to silver and gold and anything that exists outside the digital surveillance matrix of the modern financial system. Physical silver in your possession is not reportable in the same way. Physical silver does not generate taxable events until you sell it. Physical silver is the escape hatch from a system that is becoming increasingly extractive and invasive. The Dutch proposal is a signal. It is a warning of what is coming to other jurisdictions. And the smart money is already reacting. The capital is already flowing. The demand for physical metal is already accelerating in response to the regulatory environment becoming more hostile to paper wealth. This is the macro backdrop that makes Middelkoop's prediction not just plausible but likely. We are not operating in a normal market environment. We are operating in a world where currencies are being debased at record rates, where governments are running multi-trillion-dollar deficits during peacetime, where central banks have lost control of the bond market, where geopolitical tensions are fracturing the global trading system, where industrial demand for silver is exploding due to the energy transition. Solar panels now consume 29% of industrial silver demand. Electric vehicles use twice as much silver as conventional cars. Artificial intelligence data centers require massive amounts of silver for their electronics and thermal management systems. The green energy transition is not a future trend. It is current reality, and it is consuming silver at rates that the mining industry cannot match. The Silver Institute reports 4 consecutive years of supply deficits, 4 years where demand exceeded supply, 4 years where the stockpiles were drawn down. And the deficit is structural. Over 70% of silver is produced as a byproduct of other mining operations. You cannot simply increase silver production without increasing lead production and zinc production and copper production. The supply is inelastic. It cannot respond to price signals in real time. This is why the squeeze is inevitable. This is why the price has to go much higher. The market must ration the available supply through price. It must destroy enough demand through high prices to balance the equation. And the level at which demand destruction occurs is not $100. It is not $200. For industrial applications that have no substitute, the price can go to $500 or $1,000 before manufacturers start redesigning their products. A solar panel needs 15 to 25 grams of silver. That silver might cost $20 at current prices. If silver goes to $500, that silver costs $100. Is that enough to make the solar panel uneconomic? Maybe for some applications. But for most, the answer is no. The value that the solar panel generates over its lifetime dwarfs the input cost of the silver. The demand is inelastic up to very high prices. The same is true for electric vehicles. The same is true for medical equipment. The same is true for electronics. Silver is essential. Silver is irreplaceable. Silver is not optional. And that means the demand will persist even as the price rises to levels that seem insane by historical standards. Rashad Hajiev is right. The gold to silver ratio is starting to matter again. After years of elevated readings above 80, the compression has begun. Silver is outperforming gold for the first time in years. The ratio is falling. And if history is any guide, if the patterns of previous bull markets repeat, the ratio will continue falling until it reaches the lower band of that multi-decade channel, somewhere around 18. At 18 to 1, with gold at 6,000, silver is above 300. With gold at 8,000, silver is above 400. With gold at 10,000, silver is above 500. These are not fantasy numbers. These are mathematical outcomes based on historical ratio behavior and reasonable gold price projections. And here's the thing that keeps me up at night. Gold at 6,000 is not extreme anymore. Gold at 8,000 is not outlandish. In a world of $35 trillion national debts and $2 trillion annual deficits and central banks printing trillions to monetize government spending, gold at 10,000 or 15,000 or 20,000 is not just possible. It is probable. The dollar is dying, the measuring stick is shrinking, and gold priced in dying dollars has nowhere to go but up. If gold goes to 10,000 on the dollar collapse and the ratio goes to 18 on the silver squeeze, silver goes to $550. That is the math. That is the multiplication. That is the leverage that silver provides in this environment. Middlecoop says 4 to 500 by Q2. Hajiev's math supports those numbers. The short positions are at their lowest in over a year. The industrial demand is at all-time highs. The supply deficit is structural and worsening. The paper market is diverging from the physical market. The manipulation is failing. Everything is aligning. Every data point is confirming. Every indicator is flashing the same signal. Silver is about to experience a move that will be written about in financial textbooks for the next century. You have a choice to make. You can dismiss this as hype. You can dismiss this as fantasy. You can tell yourself that prices like $400 and $500 are impossible. You can wait for more confirmation. You can procrastinate. You can hesitate. Or you can recognize that the window is closing, that every day you wait is another day closer to the squeeze triggering, that the price you can buy it today will seem like a distant memory when the cascade begins. $103 feels expensive if you remember $30, but $103 is a steal compared to $300, compared to $400, compared to $500. The anchor bias is your enemy. The memory of lower prices is clouding your judgment. You need to look forward, not backward. You need to see where this is going, not where it has been. JP Morgan is trapped. The shorts are cornered. The ratio is compressing. The physical is overpowering the paper. The squeeze is coming. And when it hits, the gains will be measured not in percentages, but in multiples. 2x from here is $200. 3x is $300. 4x is $400. 5x is $500. These are not decade-long projections. These are Q2 possibilities. These are months away, weeks away. The fuse is burning. The countdown is running. Willem Middlecoop did not make this prediction lightly. He did not stand on that stage in Vancouver and throw out random numbers for attention. He made this prediction because the evidence supports it, because the math demands it, because the manipulation cannot survive contact with the physical reality of supply and demand. Silver is finally threatening JP Morgan. Silver is finally breaking free. Silver is finally going to achieve its true value after decades of suppression. $400 to $500 by Q2. That is the target. That is the timeline. That is the opportunity of a lifetime sitting right in front of you. This is financial crux. The squeeze is coming. The shorts are trapped. The ratio is collapsing. And the price is going where it has always belonged. Get your metal while you can. Get it while the price is still denominated in hundreds instead of thousands. Get it before the window closes and the squeeze triggers and the cascade begins. Silver is not just a trade anymore. Silver is a reckoning for the banks that manipulated it, a reckoning for the paper that suppressed it, a reckoning for the system that tried to pretend it was not money. The reckoning is here, and the price target is $400 to $500. Stack hard, stay positioned. And I will see you in the next one. This is Financial Crux. The trap is set, the squeeze is imminent, and silver is about to make history.